This is a presentation of Chapter 1, Introduction to Managerial Accounting. In Part 1 of Learning Objective 3, we're going to compare the financial statements of a manufacturer to those of a service and merchandising company and talk about the flow of costs through the manufacturer's accounting system. So manufacturing companies do have differences in their financial statements from service and merchandising companies. We have studied both service and merchandising companies in Accounting Principles 1. First, we're going to look at differences in the company's balance sheets. So service companies sell time, skills, and knowledge, and so they have no inventory shown on their balance sheet. However, merchandising companies will buy products from suppliers and record the cost of the inventory purchased as an asset. Merchandise inventory will be shown on their balance sheet. And as we've learned in the earlier presentation, manufacturing companies actually keep up with three different types of inventory accounts. They have raw materials inventory, work in process inventory, and finished goods inventory. So on the manufacturing company's balance sheet, we're going to see all three types of inventory in the assets section. So this slide shows a comparison of the assets section of the balance sheet for service, merchandising, and manufacturing companies. When we look at the service company, we don't see any merchandise inventory shown. However, in the merchandising company, we do see that they show merchandise inventory as an asset. When we look at the manufacturing companies, we see those three accounts: raw materials inventory, work in process inventory, and finished goods inventory. There are also differences in the income statements for service companies and merchandising and manufacturing companies. Service companies do not have any product costs, so they're only going to record period costs such as salaries expense and rent expense. However, in contrast to service companies, merchandisers' income statements usually are going to report cost of goods sold as their major expense. So cost of goods sold is the cost of the merchandise inventory that was sold by the company in that accounting period. In a manufacturing company, just as in the merchandising company, there will be cost of goods sold as usually the largest expense. However, because the manufacturer makes the product it sells, the calculation of cost of goods sold is different. So in this slide, we are comparing the income statements of the service companies to the merchandising and manufacturing companies. So as we said in the previous slide, only period costs are shown in the service company income statement. However, in the merchandising company, we now see the calculation of cost of goods sold. So to calculate cost of goods sold for a merchandising company, we start with beginning merchandise inventory, then we add to that any purchases and freight in to get cost of goods available for sale, then we subtract ending merchandise inventory to determine cost of goods sold. For manufacturing companies, we're going to start out with our finished goods beginning inventory, and then we're going to add to that the cost of goods manufactured, which we will calculate ourselves in a separate schedule. Adding finished goods inventory to cost of goods manufactured gives us cost of goods available for sale. From that, we subtract the ending finished goods inventory to get cost of goods sold. So I always like to tell students that you can compare these and see that instead of purchasing those finished goods as the merchandising company does, the manufacturing company is actually going to manufacture those goods. Otherwise, the calculation of cost of goods sold is very similar. Now we're going to talk about the overall flow of product cost in the manufacturing company. The manufacturing company is going to make purchases of raw materials, and those will be entered into raw materials inventory. Any that are not used at the end of the accounting period will be shown on the balance sheet as raw materials inventory. However, the raw materials that are used will be entered into the manufacturing process by placing those in work in process inventory. We will also add direct labor and manufacturing costs to work in process. Any work in process goods that are not completed at the end of the accounting period will be shown on the balance sheet as work in process inventory. Any goods that are completed during the period will be transferred to finished goods inventory. Finished goods inventory that are unsold at the end of the accounting period will remain in finished goods inventory and shown on the balance sheet. Any finished goods that are sold will be transferred to cost of goods sold, which is part of the calculation of the income for the company. And that is the completion of the first part of Learning Objective 3.